Good morning, students. Welcome to this special aspect of our classes. In this, we are going to deal with the statutory updates that have come in past 1 year pertaining to different topics and pertaining to different chapters in our syllabus. Now, since we have two dedicated lectures for this, I'll first start with statutory updates, which are up to January attempt, because these may also not be part of your module, especially if you all had taken the modules earlier. So we'll go by first dealing with the statutory updates up to the very recently concluded attempt, so that past whole 1 year statutory updates, which may not be part of your modules in case you have older modules, will get covered here. And then we'll go to the final statutory updates, which are applicable for our exam, that is May 26. Now, let me start. So first, update under the chapter of supply. Now, what is this update or what is this clarification? So there is a circular which talks about the applicability of GST on penal charges. Now, why this issue has come up? Because first, let us understand that whether penal charges are liable to GST. Now, there is already an old circular of the year 2022, circular number 178/10/2022. This circular had clarified long back in 2022 that when there is any penalty clause incorporated in your contract, which is normally the feature, and you happen to breach any of the aspects of the contract because of which this penalty gets triggered, there is no GST applicable on such penalty. So this was already an old clarification. Now, what this new clarification deals with, it again deals with penal charges only, but it deals with penal charges levied by some specific entities who are called as regulated entities. Why these are called as regulated entities? Because they are regulated by some special bodies. So who are covered here? Banks and NBFCs. Now we all know they are regulated by RBI. So these bodies, they started levying penal charges for non-compliance with loan terms. Now this you would know that RBI had asked them to discontinue the use of penal interest. So if let us say somebody misses to pay the installment in time, then they used to levy penal interest. However, RBI in 2023 has asked them to not levy the penal interest. So what they did was they changed their mechanism and they started levying penal charges. So in case if you do not comply with loan terms, penal charges was being levied. Now the question raised is whether these penal charges are leviable to GST. The answer is same, in lines with the old circular, that even these penal charges will not be leviable to GST because there is no supply involved. Hence, the answer given in the circular is penal charges levied by these regulated entities in compliance with RBI directions are in the nature of charges for breach of contract, and hence no GST is payable. Let us proceed. Now comes the next part, that is amendment in some RCM services. As we know, RCM is notified through notification number 13/2017 of the central tax. Now in this, there are some amendments. First amendment is relating to sponsorship service. Now sponsorship service was covered under RCM if it was provided by any person to a body corporate or a partnership firm. Now what is added in this is it should be provided by any person other than a body corporate. So the effect of this amendment is that if a body corporate is providing sponsorship, it will no more be covered under RCM, it will go to forward charge. So this point you should make a note of that now onwards, if a body corporate is giving or is conducting an event in which sponsorship is done, so body corporate is providing a service by way of sponsorship, then RCM will not apply. The body corporate, that is the event organizer, will be paying tax under forward charge. Next is amendment relating to services of renting of commercial properties. Now, for renting of commercial properties, the RCM triggered if the supplier was unregistered and the recipient was registered. Now, this was creating a challenge because many times the registered entities used to be small businesses who have taken the shops on rent and they are covered under the composition scheme, or small professionals whose turnover has not exceeded 50 lakhs. They have taken some office on rent and they are paying the rent. Now, in this particular case, whenever such registered persons who are covered under composition scheme, they were being saddled with this RCM. So to remove the hardships, this particular entry is slightly tweaked by adding this particular part. So now what is the effect of this amendment? If an unregistered person is giving a commercial premises on rent to a registered person, RCM applies provided the registered person is not a composition dealer. It means the registered person should be registered as a regular dealer, then only RCM will apply. Next clarification is with respect to input tax credit, which is available to e-commerce operator. Now, in this, what is the question? See, for e-commerce operator, there are challenges because e-commerce operator is covered under taxation in two manners. One, for its own services, which it is itself providing. Two, those notified services which are mentioned under notification issued under section 9 bracket 5. Now, there are some notified services mentioned under 9 bracket 5 for which the supplier is some other person, but under 9.5, ECO is the person who is made liable to pay GST. So ECO is effectively paying GST on two services. One, its own service. What is the own service of ECO? Since ECO is running the electronic platform, it is levying some platform fee commission from the users of the platform, that is the suppliers who have registered themselves on the platform. So this is the own outward service provided by ECO. And the second is where the ECO is required to make payment of tax on behalf of the suppliers whose services are notified under 9.5. Now, in this particular case, the question that arose was whether ECO, who is required to pay tax under 9.5, that is for some other person's service, is liable to reverse proportionate ITC of his inputs or input service to the extent of supplies made of other person through ECO, which is taxable under 9.5. Now, the issue is that when I'm providing services on behalf of some other person, there is no ITC which I am eligible for those services because they are not my outward services. Only I have been made liable to pay tax on those services, that's it. But those are not my outward services. Now, in this particular case, when I am paying tax on those services which are not my outward services, the question is whether for those services I have to reverse the ITC. Now, here again, there was an earlier circular in 2021 which said that ECO shall not be required to reverse ITC on account of restaurant services where the ECO is required to pay tax under 9.5. Further, it has also been clarified that ITC will not be allowed to be utilized for payment of tax liability under 9.5, and the whole tax liability under 9.5 is required to be paid in cash. So, wherever as an ECO, you are paying tax on services provided on behalf of some other person, or those persons are providing service through your portal and you are made liable to pay tax under 9.5, The only requirement is, since it is not your own output service, you have to discharge that whole amount of tax in cash. You cannot utilize ITC against it. However, whatever is your own ITC for running your business, that is fully available, that is not required to be reversed. This was a clarification issued in 23. Now, the new circular dated 2024 December, it further clarifies that PCO will be required to pay the full tax liability on account of supplies which are covered in 9(5) in cash. That is already what is known. That is only through cash ledger. The credit availed by him in relation to inputs and input services used to facilitate such supplies cannot be used for discharge of such tax. However, such credit can be utilized by him for discharge of tax liability in respect of supply of service on his own account. Or Katori or so much. So, the input tax credit which the ECO has availed, the ECO can fully utilize that input tax credit. No portion of that input tax credit will be required to be reversed. Next clarification is about DDA. Whether DDA, that is a Delhi Development Authority, can be treated as a local authority. Now for this, you need to recall the definition of local authority which is given under the Act, which means municipal committee, Jilla Parishad, district board, or any other authority who is legally entitled or entrusted by the central government, state government with the control or management of a municipal or local fund. So, wherever these authorities are given the responsibility of managing a local fund, they would be termed as a local authority. Now, what is the case with DDA? It has been clarified that DDA cannot be treated as a local authority. Why? Because it does not meet this specific requirement mentioned in section 269, because it is not empowered to manage a fund. Correct? Now coming to place of supply. Now in relation to place of supply, if you remember, a new section 10 bracket 1 bracket CA, small ca, was introduced for supplies to unregistered recipient. Now, in this relation, there is a clarification. It talks about place of supply of online services by suppliers of service to unregistered recipient. Now here, what is the challenge? Now under section 12(2)(b), what is the place of supplies of rules saying? It says that the place of supply of service except the services specified in subsection 3 to 14 made to any person other than a registered person shall be the location of the recipient where the address on records exists and the location of supplier where the record is not having the address. So we are talking about not 10(1) CA, not that point, we're talking about 12(2)(b). So under 12(2)(b), which is the general rule of place of supply for services where your recipient is unregistered, the place of supply will still be considered as the recipient's location. But when the address of the recipient is available on your record. However, if the address of the recipient is not available on the records of the supplier, then the provision 12(2)(b) says, we shall consider place of supply as the location of supplier itself. Now, in relation to this, when we go to the invoicing provisions under GST, what it says, a registered person supplying taxable service shall, before or after the provision of service, but within a prescribed period, issue a tax invoice showing the description, value, tax charge, and such other particulars as may be prescribed, provided that the government may, on recommendation of the council by notification, specify the category of services or supplies in respect of which tax invoice shall be issued within such time manner as may be prescribed, and subject to conditions mentioned therein, specify the category of service in respect of which any document issued in relation to supply shall be deemed to be a tax invoice, or the tax invoice may not be issued. Now, these are the express provision of section 31 bracket 2. Now, what is the challenge which is being created? Now, because of this 31 bracket 2, the government is empowered to notify those transactions in which tax invoice may not be required to be issued, or where the tax invoice may be issued not in the exact form, but in some form of other document. Like I'll give you example, when you travel by bus, AC bus, where GST is applicable, there is no proper tax invoice given, including travel by AC coach of railways. There is only a ticket which is issued. However, the condition of issuing proper tax invoice has been relaxed in such cases. Now, similarly, in Rule 46, Clause F, what is mentioned? Name and address of the recipient, and address of delivery, along with name of state and its code, if such recipient is unregistered, and where the value of supply is less than 50,000, and the recipient requests that such details be recorded in the invoice, provided in cases involving supply of online money gaming, or in cases where any taxable service is provided through e-commerce operator, or by a supplier of online information database access or retrieval services to the recipient who is unregistered. So when these services are provided to unregistered recipient, what is the relaxation given? Irrespective of value of supply, the tax invoice to be issued by the registered person shall only contain the name of the state of the recipient instead of proper address. Now, what is the conflict? The conflict is 12(2)(b) says where the address of the recipient is available on record, we will take the recipient's location as place of supply. However, Rule 46F read with Section 31 has relaxed writing the address. It only requires to mention the name of the state. Now, in this particular case, where only the name of the state is to be mentioned and the entire address is not to be mentioned, the question is, what rule under 12B will apply for determining place of supply? Because here the law itself has relaxed the condition of maintaining the complete record. It only requires recording the name of the state. Now, in this relation, what is clarified is, in such cases, the place of supply of such service shall be considered as location of the recipient of service as per the provisions of 12B. So, even though the entire address is not maintained, only the name of state is mentioned, it will still be considered as the complete address, and you will apply 12(2)(b) clause 1, because of which the place of supply will be the address of the recipient only, which is not the complete address, but only the name of the state. But that would be suffice. Just a minute, students. So what is the final clarification? So the combined reading of these definitions, what it is making out, it makes out that in case of these three services, online money gaming, or services provided through ECO, or services of OIDER, in such cases, it is clarified that the provisions of proviso to Rule 46F shall be applicable in respect of these three services, and in such cases, the complete address is not required. Only mentioning the name of the state will be considered as address, and hence the place of supply will be the location of the recipient. Therefore, In respect of following cases of supplies to unregistered recipient, suppliers are required to record the name of the state on the invoice, irrespective of the value, and to declare the place of supply of said service as the location of the recipient based on the name of the state of the recipient. So they need not maintain the complete address. Even mentioning or maintaining the name of the state is sufficient, and the place of supply shall be determined as the location of recipient. Now, relating to exemption. Now, in exemption, there are some cosmetic changes, like in case of services supplied by the electricity transmission or electricity distribution utilities, there was a typographical error whereby it said that it has to be supply of transmission and distribution of electricity both. So when you say and, we know that it means both. However, today the MSCB boards, which were earlier boards, are now split into three different companies. One is the generation company, one is the transmission company, and one is the distribution company. Now, because of this, practically, these companies are separate companies and they are doing only one of the activities, not both. Hence, to avoid that type of wrong interpretation, they have removed the word and substituted with or. Thereby now, either it can be supply of transmission of electricity or it can be only distribution of electricity. One of them is sufficient, right? Next is where services are provided by any of these. In that, one name is added, that is the name of the training partner who is approved by the National Skill Development to be eligible for this exemption. Now, this is important. Whenever any accident happens and the person who passes away is not having an insurance, then we have a special act of Motor Vehicles 1988, which provides for Motor Vehicle Accident Fund, so that these people can be given the compensation. Now, what has been made exempt is services of insurance provided by this Motor Vehicle Accident Fund by way of contributions made by insurers out of the premium collected for third-party insurance of motor vehicle. So many times when we are insuring our motor vehicle, we make a third-party insurance. This third-party insurance premium is what has been made exempt. Some definitions are added. Insurer has the same meaning as assigned to it in section 9 of 2 of Insurance Act, and that covers an Indian insurance company, statutory body established by an act of parliament, an insurance cooperative society, or a foreign company engaged in reinsurance business through a branch established in India. So they have added the definition of insurance, but for that they have referred to the definition under the Insurance Act. Now coming to the next clarification. This clarification is in respect of applicability of GST on facility management services provided to the MCD. Now this is a very one-off cases. But this clarification will automatically be applicable to similar other cases. Now what is the issue? Now this MCD is a local authority, local body. There is no doubt in this. Now there is an entry in our exemption chapter which says that where pure services are received by government or local authority, those pure services will be exempt. But the condition is that the pure services should be related to any activity mentioned in Constitution's Article 243W, 243G. Now what is happening is, as a MCD, it is availing multiple inward services like housekeeping, maintenance, furniture maintenance, garden maintenance, etc. Now, for all these services which this MCD is availing for maintaining its office, the question was that can these be exempt under entry 3A? Now, as I said, entry 3A says what? Where you are receiving either pure service which is given in entry 3 or services where the goods component is not exceeding 25% of total service value, which is entry 3A. In both these entries, the concern or the requirement is that only those activities which are in relation to a function entrusted to the panchayat under Article 243G or entrusted to the municipality under Article 243W, only those activities will be eligible for exemption. Now, whether these services which the MCD is availing of housekeeping, civil maintenance, furniture maintenance, garden maintenance, etc., whether they are covered in any of the functions of the Gram Panchayat or the municipality, answer is no. These are not those services which are mentioned in 243G or 243W. Hence, the clarification given is that these services which are received for the upkeep and maintenance of the MCD building, they are not covered in the exemption because they are not related to the functions entrusted to municipality or Gram Panchayat. Now the next case. Now what is this next case? Clarification in respect of exemption to payment aggregators in relation to settlement of an amount up to rupees 2000 in a single transaction through credit card, debit card, charge card, or other payment card services. Now, what is this? So, there is an entry in the exemption notification which says that whenever you go to a shop, you swipe your card for payment. If the payment that you are making is not exceeding 2000 rupees, that is the shopping which you have done and for which you have swiped your card, this amount is not exceeding 2000. In that case, whatever is the bank charges imposed for using the card machine, that bank charge, which may be 20, 30, 40, 50 rupees, will be exempt from GST. So firstly, what is the exemption entry? Where your amount that you have swiped using the card is not exceeding 2000 rupees, then whatever is the bank charges imposed on the usage of that card, that bank charge is exempt from GST. Now, what is the clarification? Payment aggregators are entities that facilitate e-commerce site and merchants to accept various payment instruments from their customers without the need for the e-commerce site and merchants to create a separate payment integration system of their own. So, there are payment aggregators like Razorpay and all who provide you this facility that similar to swipe card, you can now, whenever you take any online courses, the payment is to be made through any of these payment aggregators. Common example is Razorpay. Now they are providing these online websites to get the payments from their customers. So in the process, this PAs, that is payment aggregators, receive payment from customers, pool and transfer them to the merchants within a specified time. So all buyers online, they will make payment to this particular payment gateway, and the payment gateway will collect everybody's payment and forward it to the supplier. Now in this particular case, whether entry under 34, which says that exemption is provided to services by an acquiring bank, whether it will also apply to these payment gateways where the amount is not exceeding 2000 in a single transaction. So for this, we have to go to the definition of acquiring bank, which has been defined to mean as a banking company, financial institution, non-banking financial company, or any other person who makes the payment to any person who accepts such card. Now, in this particular case, the question is whether these payment aggregators are covered. Now, for that, you have to further read this. What does the definition says? It says any other person who makes the payment to any person who accepts such card. So in the definition, you have any other person written. So what is clarified is that payment gateways are defined as entities that provide technology infrastructure to route and facilitate the processing of an online payment transaction without involvement in handling of funds. So, the clarification is that these payment gateways will fall within the definition of acquiring bank. In which part? In that any other part, provided they are covered by RBI, that is, they are regulated by RBI. So those payment aggregators who are regulated by RBI, they will come under the exemption entry, and wherever the individual payment is up to 2000, then whatever are the charges imposed by these payment aggregators to businesses, that will be eligible for this exemption. Further, it is also clarified that this exemption is limited to the payment settlement facility only, which involves handling of money and does not cover payment gateway service. Now, what is this payment gateway service? As you know, we use the payment gateway by way of, we use it like whenever you want to do a booking, you use some payment gateway to make payment where they impose convenience fee. That convenience fee is not covered over here because in that particular case, they are not acting as payment aggregators on behalf of any merchant. So you are using the facility as a customer and customer of making payment using Paytm or any such payment gateway. So for your transaction, whatever convenience fee they are levying, that is liable to GST. Next is time of supply. Now, this was a big issue right from day one of GST. Now, there are time of supply provisions for supply of voucher. Now, what are vouchers? Vouchers are prepaid instruments which are used to settle your outstanding amount. So, whenever you are going for shopping, and if you have any voucher, by giving voucher, you are settling the amount because vouchers are treated as payment instruments. Now the question was whether GST is applicable on the vouchers. Now in this relation, there is different case scenarios. First, where voucher is covered as a prepaid instrument recognized by RBI. So where it is a prepaid instrument recognized by RBI, it falls within the definition of money, hence outside GST. Second, where voucher is not covered as a prepaid instrument recognized by RBI, in such cases, voucher cannot be treated as money. However, in this case, the voucher will be treated as actionable claim. So in any case, whether the voucher is a prepaid instrument recognized by RBI or not, but whenever you are using this voucher to settle your outstanding payment, the voucher will be outside GST because either it will be money or either it will be actionable claim. In either case, it is outside GST. So first thing, voucher per se will neither be treated as goods nor be treated as service under GST and hence outside GST. Now the question comes that what will be the tax treatment of the transactions of vouchers. So for that, again, we have to check what is the nature of transaction. So where the transaction is in voucher themselves, that is, you are buying the voucher so that you can make payment of some goods or services using the voucher. In that case, there is no GST on the voucher transaction itself, where the transaction involves purchase of voucher and then using the voucher to make payment. Second, GST treatment of transaction in vouchers by distributor, sub-distributor agents. Now here there are two models. What are the two models? Where vouchers are distributed through distributor, sub-distributor on principal to principal basis, means the person who has created the voucher will sell the voucher to distributor, distributor will sell it to sub-distributor, sub-distributor will sell it to dealers, means they act as traders of vouchers. Now where they act as traders of vouchers, that is, they are dealing again in the vouchers, then there is no GST. However, where these distributors, sub-distributors are not dealing in vouchers, but for passing on the vouchers, they get some commission. That is the only case which is leviable to GST. So In case of purchase and sale of voucher, since voucher is neither goods nor service, there will be no GST on the voucher itself because it is neither goods nor service. However, where you are getting some commission or fee for the purpose of passing on this voucher in the distribution chain, then this commission or fee will be leviable to GST. Next, what will be the GST treatment of additional services such as advertisement, co-branding, marketing, promotion, etc.? So many times on the face of the voucher, many of these things are printed, which acts as marketing, advertisement, branding, etc. These services are fully taxable. So two types of activities are taxable. One is where vouchers are transacted on commission basis, that is for passing on the voucher in the distribution chain, you receive commission that is exempted from GST. Second, where the vouchers are used for providing other additional services like branding, marketing, advertising, then these services are also fully taxable. Now comes the next question. What would be the GST treatment of unredeemed voucher? What is unredeemed voucher? A company sold the voucher, but that voucher was never encashed. And the time validity of the voucher is over. Now, in such cases, since the voucher was never encashed, then whatever is the amount received against the voucher, that becomes income of the company called as breakage. Now the question is whether this particular income can be taxed. The answer is no, because there is no supply involved. It is like you have taken advance, but the person never turn up for purchasing the goods or service. This advance cannot be treated as taxable because there is no supply made against it. Hence, it is not taxable. So the breakage income, whatever is received by not redeeming the voucher, will not be leviable to GST. Hence, it is clarified that no GST appears to be payable on such amount attributable to non-redemption of voucher, which is many times called as breakage. Okay. Now, some amendments relating to input tax credit. Fine. Clarification on availability of input tax credit. As per clause B of section 16(2) of the CGST Act, in respect of goods which have been delivered by suppliers at his place of business under X works contract. Now, what is this issue? So the issue is many times you are required to take delivery at the supplier's place itself. That is, now this practical example is, let us say this is Mahindra and Mahindra company, which is the original equipment manufacturer. It has manufactured the latest Mahindra vehicles, and this person is the automobile dealer who sells these vehicles from his showroom. Now, it is the policy of these companies that they ask the dealer to come and collect the vehicles. That is, the vehicles are not delivered by the company to the dealer's premises. The dealer has to go to the company premises, wherever the company's factory is. And from there, they are required to collect these vehicles. Now, in this particular case, where the automobile dealer is going to the manufacturer's place and collecting the vehicles, what will be the GST treatment? Now, the question is GST treatment of what? So for this, we have to first recall a section which is relating to input tax credit eligibility, which is section 16(2) clause B. What does this section 16(2)B says? This section 16(2)B says that whenever you want to avail input tax credit, there are some conditions given in section 16(2). You have to satisfy all those conditions. One of the conditions is under 16(2)B, which deals with receipt of goods or services. Now, Here the question is, when we will say that the goods or services have been received by the dealer so that the dealer can claim the input tax credit. For this, let us take an example. So, firstly, what is the setup? The dealer has to send its own vehicle to the manufacturer's premises, which may be in Gurgaon, which may be in any other place, maybe in some interior places where there are some subsidies or exemptions. Now, it may take around 15 days for the dealer to get the vehicle to his showroom. So, for example, the dealer has collected the vehicle on 25th of February from the manufacturer's premises. However, they reach the dealer's place today on 11th of March. Now, in this particular case, the question arises as to whether the dealer can take the credit in the month of February itself, or it will wait till the goods reach his showroom, that is in March. This is the question that which is addressed over here. So as we see in these long vehicles, the vehicles that are to be brought to the dealer's showroom are transported. But the point is, dealer has to send his own truck, gets the vehicle loaded from the factory of the manufacturer, and from that factory, bring those vehicles to its showroom. In this particular case, what is the date of receipt? That is what is clarified over here. It says, in such case, the property in the goods is considered to have been passed on to the dealer by the OEM upon handing over of the said goods to the transporter at the factory gate itself. Since the dealer has to arrange for the transport, the dealer is sending its own truck to get the vehicles from the factory. It means the moment the factory person loads all the vehicles on the truck, the property in the goods is passed on. Now, the question is, the property in goods which is passed on is an invisible feature. We are concerned in section 16 to be with the receipt of goods. Question is, what is receipt? Whether receipt by the dealer at his showroom is a receipt, or even where on behalf of the dealer, the transporter of the dealer, when it takes the delivery from the factory, whether that is receipt, that is what is the main question to be understood here. Now, for this, what is firstly said, that the property in the goods is passed on by the dealer, passed on by the manufacturer to the dealer at its own factory gate, which means that the goods can now be considered to have been delivered to the dealer, not directly, but through the transporter of the dealer. So, once the transporter of the dealer who has gone to take the delivery of those vehicles, once the transporter takes all the vehicles in its custody, in its control, that moment the property in the goods is passed, and hence we can say that the transporter has received the goods on behalf of the dealer. Now, if you remember, students, Contract Act, in Contract Act, there is a concept called as bailer bailey, which is specifically made for these transactions of transport. So we can say that the transporter is acting as a bailee on behalf of the recipient of goods, which is the dealer. So since now the goods belong to the dealer at the factory gate of the manufacturer, hence it is said, or it is to be treated, that the dealer has received the goods at the factory gate of the manufacturer, even though the goods will be physically reaching the dealer after some period of time when the goods or the truck reaches the factory. Hence, it is clarified that as per explanation to clause B of section 16.2, the dealer can be considered to have received the said goods when, at the time when the goods were handed over to the transporter of the dealer, which is at the factory gate. Hence, in such cases, the receipt is completed in my example on 15th Feb though the goods may physically reach the showroom on 11th of March, but because the receipt is completed on 15th Feb, hence we will be taking ITC in the month of February itself. So what it further says, thus the same principle is applicable in respect of supply of other goods also, where the contract between supplier and recipient is X work. So not only for this particular one example, this was only given as an example. In all cases where the transporter is taking the delivery of the goods and the property in the goods passes on at that moment of time, it will be considered as due receipt. Thus, if goods are found to have been diverted for non-business purposes at any stage, either before physically receiving the said goods at the business premises or subsequently, the registered person shall not be entitled to ITC. So, we are saying that receipt has happened at the factory gate. Now you can take ITC in the month of February itself, but provided the goods ultimately reach your dealer's showroom. If the goods are diverted or on the midway they get stolen, destroyed, etc. So whatever credit you had taken will now be liable to be reversed as per section 17(5). Now, another important amendment is in the records chapter. Now, what does this amendment deals with? The amendment is relating to time limit for issuance of self-invoice. Now, firstly, students, let us recall what is self-invoice. So, wherever the supplier is unregistered, but the recipient is registered, and the transaction falls under reverse charge, either of 9(3) or 9(4). In such cases, the law has put responsibility under section 31(3)(f) that the recipient who is now liable to pay tax under 9(3) or 9(4) is required to raise an invoice on itself. So we call such invoice as self-invoice because the recipient is preparing the invoice on its own self. So invoice is prepared by the recipient on the recipient. Hence it is called as self-invoice. Now in this particular case, the issue was before this date, that is 1st November 2024, the section did not provide for any time limit for preparing the invoice. However, from 1st November 24, an amendment was made to incorporate an enabling provision prescribing the time period for issuance of invoice by the recipient. So in such cases, now 31(3)(f) has been amended, which requires that the invoice, the self-invoice, has to be raised, has to be prepared within a prescribed period. Now, what is this prescribed period? That is prescribed by way of Rule 47A. So what does this new inserted Rule 47A says? It says that where an invoice referred to in Rule 46 is required to be issued under Clause F of subsection 3 of Section 31 by a registered person, that is the recipient, who is liable to pay tax under RCM, he shall issue the said invoice within a period of 30 days from the date of receipt of said goods or service as the case may be. So the time limit given to raise self-invoice is now provided by this new Rule 47A, which is 30 days. Thus, invoice to be issued within a period of 30 days from the date of receiving the supply of goods or service as the case may be. Fine. Student, just give me 2 minutes, please. Okay, so let us go to the next topic. The next topic is relating to accounts and records and e-way bill. Now in this, what is the amendment? So the point relates to section 138, which is a provision relating to e-way bill. Now fourth proviso was inserted in rule 138 with effect from 10th of July to be notified from a particular date. Now this has become effective wide notification number 9/2025 dated this. So let us see what is this fourth proviso inserted rule 138 saying. It says that following person required to generate the e-way bill shall submit the details electronically on the common portal in the prescribed form. Upon validation of the details so furnished, a unique enrollment number shall be generated and communication to the said person. Now, who is this? An unregistered person making interstate transport of handicrafts, which are exempted from obtaining compulsory registration but are required to generate e-way bill. And second, an unregistered person opting to generate e-way bill. Now, what is this? See, we all know that once your turnover, sorry, not turnover, once your value of transaction exceeds 50,000, the consignment value exceeds 50,000, you have to compulsorily raise an e-way bill. This e-way bill has to be raised through the GST portal. Now the challenge is the GST portal was originally designed to allow it only for registered persons because only registered persons had the login credentials. However, it was later on realized that e-way bill applies, at least the law relating to e-way bill, both act and rules, applies to all persons whoever are making movement of goods exceeding the specified consignment value. Now, in such cases, a practical issue arose as to how can an unregistered person raise an e-way bill. So this was resolved by providing for this unique number. So now even an unregistered person can create a unique enrollment number on the GST portal, and then using that unique enrollment number, it can now generate e-way bill. Then comes the next chapter relating to payment of tax. Now in this chapter, there is reference of 74A, which is added in Rule 88B, prescribing manner of calculating interest on delayed payment of tax. Now what is this? If you remember, we had section 73 and 74. Both these sections dealt with what? Both these sections dealt with the mechanism of recovering any tax which is not paid, short paid, or any refund which is erroneously made. So for recovering these outstanding amounts, 73, 74 were the two mechanisms. However, with effect from 1st of November 2024, a new section 74A was incorporated, which said that for financial year 24-25 onwards, whenever the department has to raise any demand of short payment or non-payment of tax or for wrong refunds made, now the governing section for all these demands will be 74A and not 74. Now in this particular case, when this 74A, the new section, was made effective, it was also important to refer to this new section in various other provisions of the Act. So parallelly, they made amendment in other sections of the Act. Wherever a reference was made to 73, 74, they added 74A. However, this reference was not made in Rule 88B. So now the amendment, or you can say the correction, is made by amending Rule 88B. What does it say? In case where supply is made during a tax period are declared by the registered person in the return of the said period, and the said return is furnished after the due date in accordance with provisions of section 39, except where such return is furnished after commencement of proceedings under 73, 74, 74A in respect of said period, the interest on the tax payable in respect of such supply shall be calculated on the portion of the tax which is paid by debiting the electronic cash ledger for a period of delay in filing the said returns. So basically, what does this 88B deals with? So wherever you are making payment of tax, if this payment is made late because you have filed the return late, the question was whether you have to pay tax on the entire liability or only on the net liability which is paid using the cash ledger. So it was clarified, or rather it was, I will say not clarified, it was amended in section 50 saying that you have to pay only on the net. Now, how the interest will be calculated, that was provided in Rule 88B. This rule made reference to the earlier sections 73, 74. Now, simply the reference to 74A has been added. So this is what is the amendment. Next, going to the chapter of returns, the due date of filing GSTR 7, which is specified in Rule 66, has an amendment. Now, what is this? So, erstwhile, Section 39(3) provided that every registered person who is required to deduct TDS, which TDS? GST TDS, as per the provisions of 51 of the CGST Act, is required to file a return in Form GSTR 7 in the manner electronically for the month in which such deduction has been made, and by when? By the next month's 10th. Now, this section was substituted by Finance Act 2024 with effect from 1st of November 24, so as to mandate the electronic furnishing of return for each month by the registered person who is required to deduct TDS, irrespective of whether any deduction has been made or not. In short, it is required to even file nil TDS return. This was the amendment. So original section said that you are required to file return in the month of deduction, and this amendment said that whether or not there is any deduction, that is even if there is no deduction, still every month you have to file a return. In month where there will be no deduction, you will file a nil return, but that was compulsory. Now, therefore, filing of monthly returns in GSTR 7 was linked to the calendar month in which tax has been deducted at source. However, amendment made by 39(3) mandated furnishing of GSTR 7 for each month by the deductor, irrespective of whether the deduction is made or not. Further, the new section provides that the time within which GSTR 7 is to be filed shall also be prescribed by rules. Consequently, simultaneously with effect from 1st November, Rule 66(1) has been amended to prescribe the time within which GSTR 7 can be filed. So that is why Rule 66 is amended. So what does 39(3) says? Every person who is required to deduct tax under Section 51 shall electronically furnish a return for every calendar month of the deductions made during the month in which such form and manner and within such time as may be prescribed, provided that such return shall be filed in the month of deduction and shall be furnished to the deductor for every calendar month of the month in which such deduction has been made. So basically, the month succeeding the calendar. This TDS return has been provided in Rule 66, and the time limit provided is before the 10th of the next month succeeding the calendar month. Next amendment is made in Rule 88D. Now we just saw above that in the previous rule there was a reference missing of 74A. So this 74A was added effective from 1st of November 24. However, since it was newly added, the reference of this section was missing in many provisions. Now, one by one, they are correcting this by bringing the reference of 74A. Now, here reference of 74A is added to Rule 88D. Now, what is Rule 88D? It provides for mechanism which allows system-based intimation to the taxpayer if there is any excess ITC availed in 3B vis-a-vis what is reported in 2B. So when you are availing ITC in 3B, which is in excess of 2B, you will be given system-based intimation. This is what 88D says. Again here, 88D had a reference made to 73, 74. Now they have added the reference to 74A as well. So this is the simple amendment. Now, similar amendment is made in refund chapter also. So reference of 74A is added in Rule 96B. Now, what is 96B? It is dealing with recovery of refund of unutilized input tax credit or IGST paid on export of goods where export proceeds are not realized. So, this 96B was introduced in the law, which required that once you have made export and if you have claimed the refund, your export proceeds should be realized within the specified time as per FEMA. If these export proceeds are not realized within the time specified or within the extension, if any provided, then you are required to repay back the amount of refund which you have taken. Again, in this rule, the reference carried of 7374, but the reference of 74A was missing. So that has been added. So I'll just read out the rules. So automatically this rule is also revised. So where any refund of unutilized input tax credit on account of export of goods or of IGST paid on the export of goods has been paid to an applicant, but the sale proceeds in respect of such goods have not been realized in full or in part in India within the period allowed by FEMA, including any extension of such period, the person to whom the refund has been made shall deposit the amount so refunded to the extent of non-realization of sale proceeds. So if part sales proceeds are realized, you can keep the part refund, but to the extent the sale proceeds are not realized, that much proportionate refund you will have to return along with interest within 30 days of expiry of the period, as the case may be, or the extended period, failing which the amount refunded shall be recovered in accordance with provisions of 73, 74, 74A, as the case may be, as is applicable, along with interest under 50. Provided that where sale proceeds or any part thereof in respect of such export goods are realized by the applicant within the period allowed under FEMA, but RBI writes of the requirement of realization of sale proceeds on merit, the refund paid to the applicant shall not be recovered. So let us say many times what happens, your amount is not recoverable. So you approach the RBI for getting relaxation in the FEMA Act, and the RBI considering the situations. Let us say now, right now we have tension in West Asia. You had exported to any of the Gulf countries, and now it seems difficult to recover the amount for all these reasons. So many times RBI may allow you or waives the condition of recovering the amount. In such cases, when RBI itself has waived the condition of recovering the amount, so the restriction cannot debar your refund which you were otherwise eligible in the GST law. So that has been incorporated, that where RBI itself writes of the requirement of realization of sale proceeds, then the refund need not be reversed or recovered back. Now coming to some amendments relating to customs and FTP. Now this is an important one. So in customs, you have a special rule which says import of goods at concessional rate of duty for specific end use. We also call it as the end use based exemption. Now see, this type of exemption is not in GST law. However, this exemption existed in the previous excise law also and in the current custom law because it is continuing right from day one. Now, what is this end use based exemption? So many times when you are purchasing goods, you are purchasing goods for some specified purpose. Like for example, these goods would be ultimately used in the military equipments to be supplied to government. So let us say I'm a military equipment manufacturer. I'm sure you know that now government has started purchasing a lot of its military requirements from private sources. So let us say I am such private manufacturer who is making certain military equipments which I will be supplying to the government. And the government would be incorporating my military equipments in some of their important projects. So now government, as you know, has our Indian government has now become exporter of military equipments. So government is procuring any component part or any equipment made from me. And for making and supplying that equipment to government, I am purchasing some raw material component. Now, when I'm purchasing this raw material component, I am a private person. The person from whom I am purchasing is also a private person. So we at our end are not eligible for any benefit. However, since ultimately This particular component raw material which I'm procuring today will be ultimately used in that final product, which will be sold to government, and the government is also going to utilize it for a specific purpose. That purpose has some exemption. That is called as end use based exemption. Now, let me tell you one thing. There is no such exemption under the GST law. So whatever I am discussing is applicable to the erstwhile excise law, and it is applicable to the present customs law. Now in customs law, to cater to this type of transaction, they have made a special rule called as import of goods at concessional rate of duty. Now let us say I have to import this raw material or component from China, or I have to import it from Russia. At the time of import itself, I can claim the concessional rate of duty because I am claiming that I will be using this component for the specified end use. So what I have to do, I have to make an application, file a declaration, and give the relevant copies of the contract with the government that I have received these government orders of these particular final product, and give a declaration that in that final product, I'm going to utilize this raw material or component which I am importing. Now, once I give all this, I become eligible for taking the benefit of lower rate of customs duty on these. Now, in such cases where I am eligible for this particular type of benefit, such benefit is called as end use based benefit or end use based exemption. Now, for doing this, a procedure is prescribed in this rule. This rule was made in 2022. Now, what does this rule said? As I explained, I have to make an application. I have to file a declaration. Along with that, I have to submit all the relevant contract copies. All these things are required so that I can import the goods at the lower rate at the first end. Otherwise, what used to happen? I will first pay the entire custom duty and later on I'll go and process and get it back as a refund. So that was a tedious procedure. So to avoid that, they brought this rule whereby at the point of import itself, I can take the benefit. However, what is important is, see, I am a manufacturer of these arms, ammunition, and these defense equipment, which I may be selling to government for other projects or maybe selling to other persons, which may ultimately not be used in the notified projects. In such case, I am not eligible for exemption. But today, at the time of import, it is not known to the custom authorities as to where exactly I'll be using it. That is why this particular rule is made where a specified procedure is given, and following that procedure, I can claim the exemption today. But I have to prove them that how ultimately I use this imported raw material or component in the final product, which is ultimately going for that end use. So to prove this to them, today, after import, I have to still maintain some proper accounting, some proper records showing how I utilize this raw material or this component in the ultimate final product, which is going to the government for the specified end use. Now, when I'm maintaining these records, I have to periodically submit a report to the customs about all the compliances which I am required to make under this particular set of rules. Now, this particular report has been incorporated in this particular rules, and now the amendment is in relation to this report. Firstly, in Rule 3, which provides for definition, the definition of quarter is added because now they have made filing of this report quarterly. So what is quarter? It means a period comprising of 3 consecutive calendar months ending on last day of March or June or September or December. So in short, it is our quarter as we understand. Now, what is the amendment made in Rule 6 to 10? So what is the amendment made? First, Rule 6 requires me, that is the importer, to maintain detailed records. Now, these detailed records will be vis-a-vis this imported component. First, how much quantity and for what value I imported. Then the quantity and the date of receipt in my premises. Then the quantity of these goods consumed, including the quantity used domestically for manufacture or for export, etc. then the quantity which is sent to job work and the nature of job work, quantity which is received back after job work, and the quantity of goods re-exported. All these details I have to maintain. Now comes the main part. Whatever records I'm maintaining, I have to now file a report to the government periodically, and this periodicity is quarter. Now, what does this rule says? The importer shall submit a quarterly statement on the common portal in the prescribed form by the 10th day after the end of the quarter. So this quarterly report has been amended and incorporated in this rule, whereby now I am required to submit this report quarterly. Similarly, another procedure is for allowing imported goods for job work. So whenever I'm sending these goods for job work, as we saw in the above rule 6 also, I have to maintain detailed records of what quantity is sent, for what type of job work it is sent, how much is received back, how much is not received back. If it is not received, whether it is consumed, it is destroyed, or it is in the form of any type of loss. All these things have to be specified. Here, a time limit of 1 year is provided, that the maximum period for which the goods can be sent to job worker shall be 1 year from the date of invoice or e-way bill referred in sub rule 2. So I have to send it to job work or for job work within 1 year. Next, procedure for allowing imported goods for inter-unit transfer. Now it may happen that I have other units which are doing the next step of the manufacturing. So I am allowed to transfer these goods which I imported for the specified end use from my one unit to another unit. Again, what is the requirement in Rule 8? The importer shall maintain a record of goods sent for inter-unit transfer during the month and mention the same in the quarterly statement. The importer shall send the goods under invoice or wherever applicable through an e-way bill. And the importer shall, in relation to transfer of goods to another unit, maintain details about all these things. That is, how much is sent, how much is consumed, if there is any waste, what is done of the waste, etc. Next, procedure for supplying imported goods to the end user recipient. Now comes the last step. After I have completed my working and my final product is ready, which is now to be sent to the final end use person for its end use, what is the procedure that is given in Rule 9? And again over there, this mention of quarterly statement has been added. So I have to provide the details of this quarterly statement also. And the last part is re-export or clearance of unutilized or defective goods. So whatever raw material or components I had imported under concessional rate for this end use, if that particular item is not consumed, then I have to either re-export or I have to clear it. So the details of this re-export and clear has to be given. Here again, one, I have to give the details in my quarterly statement. Two, the time limit for this re-export is given. What is the time limit? One, it is within the period specified in the notification or within 1 year from the date of import where the time period is not specified in the notification. So I have to re-export these goods back, or I have to deal with these goods in the notified or the specified manner within 1 year of its import if no specified period is provided. Then in foreign trade policy, what is the amendment? So we know that foreign trade policy is governed by the FTP 2023, which is the last amended foreign trade policy. Now in this case, there is some trade facilitation measure introduced with an option available to the central government for consultation with the relevant stakeholders to seek their views and also provide the mechanism on best endeavor basis to inform reasons for not accepting the views concerning the formulation or amendment of the foreign trade policy. So whenever the government is making any changes in the foreign trade policy, this new amendment is providing a mechanism by which the government will first seek consultation from the various stakeholders, that is the industry and the trade. That is, the government will be seeking their inputs, point number one. Then, if any inputs of the trade and industry are not incorporated in the foreign trade policy, then this amended provision also provides the procedure by which the government will be informing to these stakeholders as to why their views are not incorporated. So somehow you can understand that this particular point is to bring accountability for the government. So firstly, the government has to seek the inputs of the relevant stakeholders. And if these inputs are not incorporated in the amended foreign trade policy, government has to give them the reason. So there is an amendment by inclusion of para 1.07a and 1.07b in chapter 1, which provides as under. What is the provision? The government, in the course of formulating the FTP and wherever it deems it is reasonable to do, may seek views, suggestion, comments, feedback from the stakeholders. Now, could be this stakeholder? Trade and industry plus importers, exporters, or even industry experts. Now, this particular input is taken for what? It is taken with regard to the formulation, incorporation of specific provisions or for amendment in the FTP. Now, 30 days time period is provided to such stakeholders for giving their comments and feedback. However, government reserves the right to suo motu formulate, amend, and incorporate any provisions without seeking any views. Second, soliciting of views, suggestion, feedback. If the view, suggestion, comments, or feedbacks are not incorporated in the FTP, the government may, to the extent possible, and if it is reasonable, provide to the stakeholders, including the importers, exporter, industry experts, the reason for not considering their views. So whatever inputs government has sought, if these inputs are not incorporated in FTP, the government has to give them a reason for not incorporating or not considering their pointers. However, the government is not obliged or mandated to disclose the reasons for not incorporating the views that has the potential to or will adversely affect trade relation with any foreign country. So whatever views you gave, those views could have affected our foreign trade relations and hence they are not incorporated. I need not give any reasons for that. Similarly, would adversely affect food, economic, or national security. So obviously, if you are giving me views saying that now I should liberalize the entire LPG sector, but today, seeing the present position, the government cannot incorporate it. In fact, it has to be now more be stringent with the LPG. So if I'm not incorporating this opinion, why? Because it may affect the food, economic, or national security, then I need not give any justification for that. If it is in conflict with the government policies, programs, etc., if it addresses matters unrelated to trade or serve narrow private or special interests. So whatever suggestions you gave was only going to benefit you individually. It is not for the trade or the industry as a whole. I need not incorporate and also not give you any clarification. Or it would require the disclosure of confidential or classified information. Again, for this, I need not give any clarification. Further, no legal rights shall be conferred on any person to seek reasons. So you cannot file any RTI for seeking reasons. There is no legal right given to you. This is only a facilitation measure. Second, extension of support under the road tap scheme. So the road tap scheme benefit will be available for exports of products manufactured from advanced authorization units, SEZ-EOU, with effect from 1/6/2025. So it has been extended and it will be with effect from 1/6/2025. The support under road tap scheme for export of products manufactured by DTA units was available till 39/25. So notification number 66 dated this, read with notification number 32 dated this. So it has been extended beyond this date and it will be up to this date. So this is what is the amendment. So with the students, we have completed the amendments, the previous amendments. Now, after the break, we will come back and we will deal with the further amendments, right? So now further amendments, we will take post Finance Act 2024. So right now our amendments were of Finance Act 2024. Now we'll go to amendments beyond 2024, that is of Finance Act 2025. This we will get at the end of every chapter. So now we will go to each and every chapter to discuss the amendments made by Finance Act 2025. And then in the next class, we will go to the last amendment which are applicable to your exam. So this is how we will cover all the statutory updates. Fine. So now we will be taking a 15 minutes break. After the break, we come back and we discuss the amendments made by the Finance Act 2025. Fine, students. So let us rejoin after 15 minutes. Thank you. 2025. I'm sure you all know that Finance Act 2026 is not applicable to us for May attempt because it has been passed within 6 months period. In fact, it is yet to be passed. So the point, whatever is there in the Finance Act 26 will not apply to your exams. Anything 6 months prior to the exam date are only applicable. So let us go to the Finance Act 25 amendments because these are definitely applicable to you because they have been notified before the 6 months period of your exams. Now, in the first chapter of supply, we have this amendment relating to the definition of local authority. Now, this local authority definition is already there in the law. So, local authority includes a panchayat, a municipality, a municipal committee, Zilla Parishad, district board, etc. Now, what is the amendment? The amendment is by way of this explanation. What does it say? For the purpose of this subclause, local fund means any fund under the control management of an authority of a local self-government establishing for discharging civic functions in relation to a panchayat area and vested by law with the power to levy, collect, and appropriate any tax, duty, toll, cess, or fee by whatever name called. So, what is a local fund? So, local fund is the fund which is under the governance of a local government, which is also vested with the power to levy, collect, and utilize the money by way of tax, duty, toll, cess, etc. This is the definition added for local fund. What is municipal fund? It means fund under the control management of an authority of a local government established for discharging civic functions in relation to a metropolitan area, municipal area, and vested with the powers to levy, collect, and appropriate tax, duty, cess. So, what they have added is the entire definition remains same, only they have added the definition of funds. Why this is added? Because if you remember, in fact, this was the amendment. There was an amendment in the previous amendment sheet also relating to local authority. In that also, this particular point was emphasized only that authority which has control over a fund, only that will come under the definition of local authority. Now here two funds are named, one is local fund, one is municipal fund. So the question is, what is a local fund? What is a municipal fund? So this local fund, this municipal fund has been defined over here to mean the fund which is constituted and which is under the control and management of the authority of the local government. So this authority has the complete disposal of this fund. Further, this authority is vested by the law the power to impose and collect and use the money by way of tax, duty, cess, etc. So that is what is the first amendment in this particular topic, correct? That is the addition of fund. Now coming to the next amendment, which is in the topic of input tax credit. Now in section 17(5)(d), which deals with block credits, there is a long series of legal battle which culminated by the decision of Honorable Supreme Court. In this particular case, the challenge was that 17(5)(c) uses the word plant and machinery, but 17(5)(d) uses the word plant or machinery. Honorable Supreme Court has said that in their judgment that this 17(5)(d) usage of the language plant or machinery cannot be changed by the courts because courts are not supposed to add or delete any word in the law. So they treated this plant or machinery as it is. They considered the or as correct usage despite of there being a lot of evidences shown in the court by the opposite side. Hence, in this particular judgment, the Honorable Supreme Court said that they are not going to correct this language of plant or machinery. Hence, after the judgment, the legislature thought that they themselves will correct this anomaly, correct this misprint. So the amendment simply is what was earlier plant or machinery has been corrected to plant and machinery. Further, an explanation has been added to make this amendment effective retrospectively. How? So it says, for the purpose of clause D, it is clarified that notwithstanding anything to the contrary contained in any judgment, decree, or order of any court, tribunal, or other authority, reference to plant or machinery shall be construed as always being deemed to have been a reference to plant and machinery. So by adding this explanation, they have clarified that the above amendment of plant or machinery is plant and machinery right from day one, and this will be irrespective of any amendment or any judgment made by court. So this is simply to counter the judgment of the Honorable Supreme Court that they have brought in this corrective amendment and they have made it effective retrospectively. Now comes the next section which deals with input service distributor. Now in this section, again an amendment has been made. Now for this, let us understand the background of this section first. So section 20, which deals with input service distributor, says what? It says that if you are a registered person under GST and you have any common office, what I mean by common office, it is that office which is receiving common input services. What is common input services? Input services which will be used by multiple units of your business. But the invoice is received at one place, that is at your common office. It may be your head office or corporate office. So this corporate office has to register compulsorily as an input service distributor. This was already an amendment made by Finance Act 2024, making it applicable from 1st April 2025, whereby now it is compulsorily required to prepare, compulsorily required to firstly register as an input service distributor and then prepare an invoice for distributing this common ITC to all the concerned entities. Now, in this relation, there was a problem. The problem was relating to reverse charge. Now, what is the problem? See, this ISG registration, which the head office will take, this registration is only allowing the ISD, that is the head office, to distribute the available credit. What it is not allowing is, it does not allow the head office to make payment of any tax. Now, what payment of tax this head office is required to make? So this head office, if it receives any invoice, let us say it receives the legal fees invoice from an advocate firm. On this, the RCM provision requires that the recipient has to make payment of tax. Similarly, if director's remuneration is paid, again RCM is applicable on the director's remuneration. Now, in all these cases, the challenge is that the ISD itself cannot make payment of these taxes because the ISD registration is not allowing to make any payment from the ISD portal. In this particular case, the challenge was how will ISD make payment of this particular tax? And secondly, whether ISD can distribute the credit of this RCM ITC. So that has been clarified, that has been corrected by making this amendment. Now, after amendment, how does the section reads? Any office of the supplier of goods or services or both, which receives tax invoices towards receipt of input services, including invoice in respect of services liable to tax under subsection 3, 4 of 9 of this Act or under subsection 3, 4 of section 5 of the IGST Act for or on behalf of distinct person referred to in section 25 shall be required to be registered as ISD and shall distribute the input tax credit in such invoice. So the amendment is relating to allowing the ISD to even distribute the tax which it has received under RCM. And earlier, it was only referring to 9394 RCM, which is of CGST Act. Now, they have also covered the IGST Act because RCM may also apply under the IGST Act. So now they have also covered 5354 in their section. Similarly, in subsection 2, similar amendment is made. So what does subsection 2 says? Now this head office, which has now become input service distributor after registration, shall distribute the credit of central tax or integrated tax on invoices which is received by him, including the credit of central or integrated tax in respect of services subject to levy of tax under 9394 or under 5354 of the IGST Act paid by a distinct person registered in the same state at the said IESD in such manner within such time period and restrictions as may be provided. So what it says, whatever input service credit it has received either from the supplier or in case of RCM. Now, as I was saying, the ISD is not allowed to make any payment of of RCM tax. Then the provision are made so that your regular registration, not ISD registration, your normal regular registration will make payment of the ISD RCM tax, and it will pass on this credit of this RCM tax paid by it to the ISD, and then ISD will distribute this credit to all the units and branches as per the prescribed formula. So again 20 bracket 2 makes a simple amendment of referring to the ITC of RCM which has been paid under 5354. So both 9394 which is for CGST, SGST and 5354 which is for IGST. Now both these ITCs on RCM are covered in ISD provisions. So this is more like a corrective amendment. It is not a substantive amendment. Now going to the next chapter, which deals with invoice and records. Now in this chapter, what is the amendment? So the amendment is in section 34, subsection 2, which deals with debit notes, credit notes. Now what is the amendment? Or firstly, what is the provision? Any registered person who issues a credit note in relation to supply of goods or service or both shall declare the details of such credit note in the return for the month during which such credit note has been issued, but not later than 30th November following the end of the financial year in which the supply was made, or the date of furnishing of the relevant annual returns, whichever is earlier, and the tax liability shall be adjusted in the manner as may be prescribed. So the first part of the provision is simple, that whenever a supply is made and after the supply is made, if any credit note has to be raised for that supply for reducing the tax on that supply, then section 34 subsection 1 has given you the situations under which the credit note can be issued, and 34.2 has given you the time limit up to which this credit note should be uploaded in your GSTR1, and the time limit is the year in which the supply happens. After the end of that year up to 30th November, you should report this credit note in your GSTR1. Now, what is the amendment? A proviso has been added which says that provided that no reduction in output tax liability of the supplier shall be permitted if the input tax credit as is attributable to such a credit note, if availed, has not been reversed by the recipient where such recipient is a registered person. And second, incidence of tax on such supply has been passed on to any other person in other cases. So what is the point? Now, whenever you raise a credit note, what you are doing by raising this credit note, you are reducing your output tax. Now, importantly, when you are reducing your output tax, you are subject to a concept called as unjust enrichment. Now, this concept is originally designed for refund, but the analogy The similar analogy is now being extended to credit note. Now, what is this unjust enrichment? I'll first explain you with respect to refund so that with respect to credit note, it will be easy to understand. So let us say I pay some tax, and after payment, I realize that this tax should not have been paid, or some part of this tax should not have been paid. It means I have paid the tax wrongly in excess. Now, if I have paid the tax wrongly in excess, I am allowed to take back this excess amount, which is called as refund. But since this is indirect tax, there is a possibility that whatever tax you had paid originally, of which refund you are seeking now, there is a possibility that you may have passed on this particular tax burden to your customer, to your buyer. Now, if you have passed on the burden to someone else, in your case to the customer or buyer, now if you want to take back this tax as a refund, you will have to first prove that this incidence is not passed on to the buyer. And if it is passed on to the buyer, you will not be the person entitled for refund. It will be the buyer who has borne the tax burden. So the principle of unjust enrichment in relation to refund is that you will get refund only if you have suffered the burden of that tax. If after paying the tax, you have passed on the burden to some other person, generally who is your customer, then even if there is a refund available on this particular transaction, but it will not be given to you. It will be given to that person who has borne the tax incidence. And in case that person is not traceable, it will go to the consumer welfare fund. Now, this analogy that you will get refund only if you have borne the tax burden is indirectly now applied to credit note by way of this proviso. So what does this proviso says? So let us say you made a supply in the month of May 2025. Later on, you realize that the tax on this supply is excess and it has to be reduced, and you comply with the provisions of section 34(1), which deals with the reasons for issuing credit note. So in short, you are eligible to reduce the tax of this supply which was made in May 2025. Now, when you want to reduce this tax burden, what is important is that along with you reducing the tax burden, the person who has availed the credit of this, that is your recipient. Now, when the recipient would have availed credit if the recipient is registered. So there are two scenarios given, one where the recipient is registered and two when the recipient is unregistered. Now, when the recipient is registered, the recipient would have claimed the credit of this. Now, if the recipient has claimed the credit of this, then you are going to get the benefit of this credit note, that is reduction in your output tax, only after the recipient has reversed its input tax credit. So whatever ITC the recipient has taken against your supply, that ITC has to be reversed by the recipient. This is the condition number one added by this proviso. So the proviso says you have to ensure that your recipient reverses the tax. If the recipient does not reverses the tax, tax means the input tax credit. If the recipient has not reversed, then you by your own self cannot, you cannot reverse the tax burden under the credit note. Now for this, earlier, the procedure was you are supposed to take a declaration from the recipient either on its own letterhead or certified by his CACM. However, after this introduction of IMS, now this particular thing will not be required because after the introduction of IMS, you will not be required or you will not be burdened with taking the confirmation from the recipient, because the moment you upload the credit note in GSTR1, it will be open in the IMS at the end of recipient, where the recipient will have the option of accept, reject, modify. If the recipient is not accepting it, it is coming back to you. It means the recipient is not reversing its credit. You cannot get the benefit of credit. In case the recipient has accepted, or if let us say the recipient has done no action, so the law says IMS will deemed accept that particular credit note. So whether the recipient has accepted or it is deemed accepted, after that, the recipient's credit ledger, ITC ledger, will automatically subtract the amount of this credit note tax from its ITC. So to that extent, automatically recipient's ITC would have been reversed. So this condition will be automatically satisfied at your end. So now for you, post introduction of IMS, specially satisfying this condition by taking any declaration from recipient is now not required. Through IMS, it is done automatically, or it will be known to you that recipient has accepted or deemed accepted your credit note, which is a sufficient compliance of this condition. Now, in the second part of this condition, what it says, incidence of tax on such supply has been passed on to any other person. Now, this will happen generally in case where the recipient is unregistered. If the recipient is unregistered, in that case, the recipient may not have taken the credit. Now you will get the benefit of this particular reduction in your output liability if the incidence of tax of such supply has been passed on to any person who is not a registered recipient. So in that case, automatically you can reverse it by your end. There will be no requirement of reversal by the recipient, because since the recipient is unregistered, there is no question of recipient taking the benefit. If the recipient has not taken the benefit, in that particular case, you are allowed to reverse this particular input tax credit. But again, this point of incidence of tax on such supply has been passed on. This has to be taken care of. So what it says, no reduction in output tax liability of the supplier shall be permitted if the incidence of tax has been passed on. So the effective meaning of this is that where the recipient is unregistered and you want to reduce the output tax by raising a credit note, you will have to follow the principle of unjust enrichment, whereby you will have to prove that the burden, the incidence of the tax has not been passed on. Now, how will you prove this? This is going to be a big challenge. If you are not able to prove this, then in that particular case, you will not be allowed to reverse your tax using the credit. Correct? I hope this point is very clear, Shubin, because this is a very important amendment, and I'm sure this amendment will reflect somewhere in your question.
Clear, sir.
Perfect. So it is indirectly the introduction of the concept of unjust enrichment, which was till date applicable only to refund provisions, has now been extended to the provisions of credit note. Now, moving forward, let us go to the next topic. Now, this next topic is relating to tax invoice. One second, sorry, returns. Now, what does this topic of returns say? Now, there is an amendment in section 38(1). Now, what is 38(1) dealing with? So, when the supplier uploads his GSTR1, which is done under section 37, the details of whatever outward supplies the supplier has uploaded in his GSTR1 is auto-generated or auto-reflected in your 2A2B. So section 38 deals with your 2A2B. Now what is the amendment? So what does section 38 says? The details of outward supplies furnished by the registered recipient under subsection 1 of 37 and of such other supplies as may be prescribed, and a statement containing the details of input tax rate shall be made available electronically to the recipient of such supply in such form and a manner within such time and subject to such conditions restrictions as may be prescribed. Now what is the amendment? Earlier the word was auto-generated statement. Now the word is a statement. Now the question is, what is the relevance of this amendment? So you have to read this amendment in relation to IMS. Now, before this IMS was introduced, now it was introduced last year somewhere in October 25. Before that, whatever supplier used to upload in GSTR1, it used to directly come to your 2A 2B without you having any control on that inward supply. So that is why section 38, which deals with 2A 2B, had used the word auto generated statement. So 2A 2B are auto generated statements. Now, after this IMS has been introduced, what happens wherever the supplier uploads any outward supply in his GSTR1, it first comes to your IMS. And in IMS, you have now the facility of either accepting, rejecting, or modifying the inward details which are reflected in your IMS. So, after the IMS action is taken by you, that is of acceptance, rejection, or of modification, then through the IMS, the matter comes in your 2A 2B. So now 2A 2B is not an auto-generated statement. Why? Because now it requires your interference, your intervention in the form of acceptance, rejection, or modification. So because of this intervention, now the lawmaker, in their wisdom, thought of removing the word auto-generated because now it is no more purely auto-generated. It is on auto-generated in IMS, but what is coming to your 2A 2B is after your intervention in IMS. So in IMS, you are supposed to take an action, and after your action, now the final 2A 2B gets generated after your action. That is why the lawmakers have removed the word auto-generated, just to mean that this statement is now prepared by you by taking the action in IMS. Fine. Second, similar amendment is in 38.2, where again the word the auto-generated statement was used. Now it says the statement referred to in subsection 1 shall consist of details of inward supplies in respect of which credit is available to the recipient, details of supplies in respect of which credit is not available to the recipient, etc. So again here the word auto-generated has been replaced to statement. Just a minute, students. Yes, students. So two amendments are made in this. So firstly, it says that now it is going to be a statement, not an auto-generated statement, as I mentioned. And second, this statement, besides reflecting what is eligible, what is ineligible, etc., it will reflect such other details as may be prescribed. So the government will prescribe what other details have to be reflected. Then comes 39(1), which is your return, the returns that you file. What it says, every registered person other than ISD or NRTP or a person who is covered under composition scheme or who is liable to deduct TDS or collect TCS shall for every calendar month or part thereof furnish a return electronically. So we know this, our returns are to be filed electronically. Now, in majority case, it is monthly and for some it is quarterly. Now the returns will show details of what? Inward and outward supplies of goods or services or both, input tax credit availed, tax payable, tax paid and such other particulars in such form manner which within such time and subject to such conditions and restrictions as may be prescribed. So now there are two amendments in different sections. One is in 38, where they are saying it will contain such other details as may be prescribed. And then there is amendment in section 39, which says there will be some conditions, restrictions as may be prescribed. Now, students, you should know that whenever the law uses the word as may be prescribed, it means there will be rules made for this. Now, till now, no rules have been made. They have only made the first step change, that is in the act, giving the power to the government to prescribe rules for doing this. One is in section 38, that is your GSTR 2A 2B. It will empower the government that they can add some details in your 2A 2B. And in 39 return, that is in your GSTR 3B return, it is empowering the government to insert some conditions and restrictions relating to your GSTR 3B. Now, what are these restrictions, conditions? Now, as you know, slowly and steadily, your 3B is getting freezed, it is getting locked. So, these are the conditions, restrictions which are being put in 3B. So, they will now be incorporated in 3B wide rules. These rules, whenever they are prescribed, they will also form part of your syllabus. Now coming to the next chapter, which deals with import and export, not of customs. We are talking about import export relating to the GST law. Now in this relation, there is one amendment in Schedule 3. Now what did Schedule 3 originally contain? Schedule 3 originally contains those transactions which are neither treated as supply of goods nor supply of service. In short, these transactions are outside the GST levy. Now, when the transactions are neither supply of goods nor supply of services, in that particular case, though no GST is required to be paid, now in this relation, you have entry number 8, which has multiple clauses. Now, what was clause A, which was already in the act, which was amended in 2019 itself? It said that what will not be treated as a supply. So, where your goods are warehoused, in a customs warehouse as per the custom warehousing procedures. I hope you remember this. We have a custom warehousing provisions whereby after import, if you do not want to take the goods immediately to your factory, you can let the goods remain in custom bonded warehouse, for which you have to follow a certain procedure. The procedure is, when you are filing your original first bill of entry, you have to file it by marking it as bill of entry for warehousing. Then on the basis of the duty assessed in that bill of entry, you have to give a bond of 3 times of the tax assessed in the bill of entry as a security. And then your goods will be moved from the port to the designated customs bonded warehouse. And then whenever you want to remove the goods from this warehouse, the maximum time period being 1 year for this removal, you will again file the second bill of entry, which is called as the X bond bill of entry. And in this second bill of entry, again assessment would be done. Now, whatever duty component comes along with applicable interest, because you have kept the goods in warehouse, if the warehousing period exceeds 90 days, then you also have to pay interest, and plus any other charges, including warehousing charges, penalty, if any. All these things you will pay. You will clear your goods, your warehousing bond will be released, and the entire warehousing procedure is completed. Now, this clause A says that between the period the goods were entered into the warehouse and they are cleared from the warehouse. In short, during the period the goods are warehoused in the custom bonded warehouse, that is without payment of customs duty. If in that period of warehousing, if you have cleared means sold, not cleared, sorry, if you have sold any goods, if you have supplied any goods to some other person, you are not required to pay GST on that. The GST will be payable by the end person who releases or who clears the goods from the warehouse. So if you had purchased originally, you had imported originally, kept it in warehouse, and before clearance you sell these goods to somebody else, still goods are in warehouse, it will not be treated as a supply. This was clause A. Now on similar lines, clause AA has been introduced. What is clause AA saying? Supply of goods warehoused in a special economic zone or in a free trade warehousing zone to any person before clearance for export or to the DTA. So when you have kept your goods, now it is not the custom warehouse. The goods are now kept in SEZ warehouse or in FTWZ warehouse. So instead of keeping in custom warehouse, the goods are lying in a warehouse in SEZ or in FTWZ. They are saying same treatment which is given for clause A will be given if you have sold these goods before being cleared from this SEZ or FTWZ. So before your goods are cleared from SEZ or FTWZ, if you sell them, then that particular sale will not be taxable. It will not be considered as a supply. Now, what is the second amendment relating to this? Explanation 2. For the purposes of clause A of para 8. What was clause A? Goods which are lying in custom bonded warehouse are sold before clearance. The expression warehouse goods shall have the same meaning as assigned to it in Customs Act 1962. Next, the explanation 3 is added. This is in relation to this new entry. What it says, for the purposes of clause AA. What is clause AA? Your goods are kept in the warehouse of SEZ or FTWZ. This expression special economic zone and free trade warehouse zone and domestic tariff area shall have the same meaning, respectively assigned to them in the SEZ Act. So this is not much important for us. It simply is that relevant explanations or definitions have to be taken from the SEZ Act. What is important for us is the goods which are stored in warehouses, one of customs, that is clause A, or of SEZ, FTWZ, that is clause AA. All these goods, if you sell them before their clearance, for you there is no GST because this transaction will be treated as neither supply of goods nor as supply of services. Correct? ठीक है. Now let us proceed to the next chapter on offenses and penalties. Now what is the amendment? A new section 122B has been inserted. So a new penalty provision has been brought in. What does this section says? So penalty for failure to comply with track and trace mechanism. Now let us first understand the law was amended and a new mechanism whereby certain goods would be notified and those goods will have to comply with the track and trace mechanism. This was introduced, this was inserted in the GST law. Now for these goods which are covered under the track and trace mechanism, a special tracking mechanism has to be installed, and using that tracking mechanism these goods would be tracked from start to end. This is what is the provision. Now for this provision there was no specific penalty provided if somebody breached this provision, that is if somebody did not keep the track and trace mechanism active for these goods, there was no specific penalty provided. So to correct that, a new penalty provision under section 122B has been brought in. What it says, notwithstanding anything contained in this act, where any person who is referred to in clause B of subsection 1 of section 148A. Now, what is this 148A? It is the new track and trace mechanism. In contravention of the provisions of the said section, he shall, in addition to penalty under chapter 15 or the provisions of this act, be liable to pay a penalty equal to an amount of 1 lakh rupees or 10% of tax payable, whichever is higher. So, the person who is contravening any of the provisions which is given in section 148A subsection 1 clause B, for them, what will be the penalty? The penalty shall be in addition to the penalty given in chapter 15, and the penalty, this additional penalty will be minimum rupees 1 lakh or 10% of the tax payable out of both, whichever is higher. So this is the amendment relating to penalties. Now, now we come to the appeal provisions. Now in appeal, we have different appeals. So section 107 deals with the first stage appeal, that is appeal to the first appellate authority, who may be a deputy commissioner or a commissioner. And then we have the next level, which is section 112, which deals with appeal to GST tribunal. Now, firstly, in relation to 107, that is the first appeal, which is to deputy commissioner or commissioner, what are the provisions? The provision is no appeal shall be filed under subsection 1 unless the appellant has in full or such part of the amount of tax, interest, fees, penalty arising from the impugning order as is admitted, and a sum of 10% of the remaining amount of tax in dispute from the said order. And there was a maximum cap of 20 crores. So what is this provision? So whenever you want to file an appeal, you have to pay in full that amount of the tax which you have accepted. So whatever liability you are accepting, that is you are not contesting, that amount you have to pay in full. Second, whatever you are contesting, that is for that amount which you are disputing in appeal, which is called as disputed amount, you have to pay 10% of that amount of tax. So the original provision is that for filing appeal at the first stage, you have to pay or deposit, in fact, deposit is the more proper word, up to 10% of the disputed tax as a pre-deposit. And the undisputed amount you have to pay in full. Now, what is the amendment? The amendment is provided that in case of any order demanding penalty without involving demand of tax. Now, this is important. So again, you have to go back to section 122. So 122 imposes penalty, and many times this penalty can be independent of tax because you may not be the originator of that particular offense. You are some intermediate person who is participating in the offense directly or indirectly. So for them, you have section 122 bracket 1A, 1B. So these are imposing certain penalties. Now, for those persons who are only acting as intermediary involved in between the chain and that person is liable for any penalty, for that person there was no pre-deposit. So let us say you are the person who is only levied penalty. There is no tax component in your order, only penalty is levied. Now for such persons, if they were going in for appeals, there was no pre-deposit provision for them. So this has been corrected by introducing this proviso. What does this proviso says? This proviso says that where your demand is without any tax, so there is no tax component involved in your demand, so there is only demand of penalty without any tax component, then no appeal shall be filed against such order unless a sum equal to 10% of that penalty has been paid. So now they have made a parallel provision of pre-deposit similar to what we studied above, that where now only your order consists of penalty amount. It is not covering tax amount, it is only covering penalty amount. You have to now keep 10% of this penalty also as pre-deposit. So without keeping this 10% as pre-deposit, you cannot file the first appeal. Now, similar provision is made in the second appeal, that is appeal to the GStat. What it says? No appeals shall be filed under subsection 1. Now we are reading section 112. This is for GSTAT appeal. So no appeal shall be filed under subsection 1 unless the appellant has paid. Now first what you have to pay? You have to pay the complete tax which you are not disputing. So in full, such part of the amount of tax, interest, fine, penalty arising from the impugned order as is admitted. So whatever liability you are accepting, pay full, and for the disputed liability, pay 10%. A sum equal to 10%, but 10% of what? Only of the amount of tax which you are disputing shall be paid in addition to the amount paid under subsection 6 of 107 arising from the said order, subject to a maximum of 20 crores in relation to what the appeal, in relation to which the appeal has been filed. So whatever is the disputed tax, you have to pay 10% of this amount, which is in addition to the amount which you have already paid under 107. Now, whatever you have paid in 107, that was already 10% as we studied above. In addition to that, you have to pay further 10%. This is the rule. Now, a parallel amendment is made again here for what? So, same case where you are some intermediary person of a fraudulent chain where the original perpetrator is levied tax also and penalty also, but you are only levied penalty. No tax is levied on you. You are only levied penalty for being some part in this particular offense. So in such cases, when you are only levied with penalty, the question is whether the pre-deposit has to be paid. Now, before this amendment, no pre-deposit was liable or required to be paid either at the first appeal stage or at the second appeal stage. So at both appeal stage, no pre-deposit was required to be paid. What it says now after the amendment, you have to pay pre-deposit even if the case is only of penalty. And how much is the pre-deposit? Same 10%. So provided that in case of an order demanding penalty without involving demand of tax, no appeal shall be filed against such order unless a sum equal to 10% of the said penalty, and this is in addition to the amount payable under proviso to subsection 6 has been paid by the appellant. So, where you are going in for appeal to the GSTAT, then again, even if your demand or the order which you are challenging is only a penalty order, you have to pay 10% of this penalty amount as the pre-deposit. Only then you are allowed to file the appeal. So without this 10% pre-deposit of penalty, the appeal cannot be filed. Fine, students, just allow me a minute. Just a minute, please. I need to check for the other chapters where there is statutory amendment. I could find only in these chapters, but I believe there could be amendment in one or two more chapters. Allow me 2 minutes, please. So yes, there is one more chapter which has amendment. Let me see if there are more chapters from customs also. Okay, in customs, I'm not finding much amendments. Mhm. There appears to be no significant amendment in the customs part relating to Finance Act. So I got one. No, but it is also not yet notified. So no use because it is not yet notified. Mhm. Mhm. So students, no significant amendments there. So then only one chapter there is amendment left. Let us complete that. Track and trace is over now. Yes. Okay. Now, provisions as amended by section by Finance Act 2025. Now, relating to this track and trace mechanism, we saw the amendment in the penalty provisions. Now, what is this track and trace mechanism? So, a definition has been inserted in section 2 bracket 116A about unique identification marking. UIM, you can call it in short. What is this unique identification marking? So, a unique identification marking means the unique identification marking referred to in clause B of subsection 2 of 148 and includes a digital stamp, digital mark, or any other similar marking which is unique, secure, and non removable. So, any type of marking put on the notified goods as per subsection 2 of 148 will be called as unique identification marking. Now, what is this new track and trace mechanism? Let us see. So, what does this new section 148 says? Track and trace mechanism for certain notified goods. Subsection 1 gives the power to the government to notify what? The goods or the person or class of persons who are in possession or deal with such goods to which the provisions of this section shall apply. So what is the government empowered to do? One, to notify the goods on which this provision will apply and notify the person who are in possession of these goods or who deal with these goods to whom the provisions of this section will apply. Now, what does this section provides? The government may, in respect of goods referred to in clause A of subsection 1, that is the notified goods, they will provide a system of enabling a fixation of unique identification marking and for electronic storage and access of information contained therein through such persons as may be prescribed. So, what is the first point to be done? For those notified goods, you have to now install a system. What this system will be doing? This system will be affixing a unique identification marking. So you should now have a system by which your products will be marked with a unique identification. Now, what is this unique identification marking? We saw the definition above. It may be a digital mark or it may be any type of mechanism by which I am able to trace your goods. So for tracing the goods, firstly, the goods will be having a digital mark. So subsection 2 clause A first requires you to have a system by which you will place a mark on your goods. Secondly, the system should also provide for electronic storage and access of information contained therein. So once you have put a mark, this digital mark should now gather information. Now, basically, what type of information will be gathered? That is, who is selling the goods to whom, what quantity, what time. So from where to where the goods will be sold. All these details are being captured relating to that particular goods, and this has to be stored. So this information has to be stored and it should be accessible. Then comes the second requirement, prescribe the unique identification marking for such goods, including information to be recorded. Second, the government will provide how this marking will be happening on these goods and what information has to be recorded in this mark relating to the goods. Then subsection 3, the person referred to in subsection 1 shall, what they will do? They will affix on the said goods or packages thereof a unique identification marking containing such information and in the manner as may be prescribed. Second, furnish such information and details within such time and maintain such records or documents as may be prescribed. Third, furnish details of the machinery installed in the place of business of manufacture, including the identification, capacity duration of operation, and such other details of information which is such time as may be prescribed, and pay such amount in relation to the system referred to in subsection 2. So what the government will be doing is, government has the power given under this section to first notify the goods on which the marking has to be placed. Second, notify the person who has to follow this provision. Then under subsection 2, the government will specify the mechanism of placing the mark and the information that would be captured and stored relating to these goods. And then in subsection 3, it is putting responsibility on those specified persons whose name is specified in subsection 1, that this particular person will be required to, one second. In subsection 3, the government will now be fixing responsibility on these notified persons. What is the responsibility? That they have to firstly affix the marking on the said goods or packages. Second, the informations and details which will be furnished by these persons, and the time and the manner of maintaining and furnishing such information. And also, the person should furnish the details of the machinery installed in their place, which will be doing this marking. Further, these persons are required to pay the amount in relation to the system referred to in 2 as may be prescribed. So this is what is 148A, that is the new track and trace mechanism. For this, the rules are yet to be provided. So how this will function, this is yet to be known because the rules are not yet made. But this section 148A has provided the mechanism or the basis for introducing the track and trace mechanism. So students, with this, we have completed all the amendments by Finance Act 2025. Now, in the next class, we will be dealing with the other applicable statutory updates which may have come by way of notification, rules, or circulars which have happened after the date of printing of the module and which is applicable to your May examination. So this we have covered of all the chapters. Now we will be covering the statutory updates again for the entire syllabus applicable to May. Yes, Sachi Beda, you have any question?
Sir, one question means like while summarizing, because I had like last attempt ka book, so I just wanted ki if I go for the new book, it will be notes will not be there, and so how I can get this ki, how I
See,
will be summarizing.
I will suggest that you still take the new book, which is anyways, we have all the modules uploaded online. You download the module and you go back to your
Download is
original
not
book.
available, sir. I was trying, but I was not able to download. If it is there, then it will be fine.
Anyways, all these notes which I'm showing on your screen, I've downloaded it and I downloaded it yesterday only. It is very easy, but on BS portal, all these modules are freely downloadable.
Acha, I had went through that students portal or uske बाद digital learning
You go
hub.
directly to
I'll
BOS
just
portal.
try.
It is allowed open to everyone. Anyone can download it.
Sir, NC means if I can have your contact number, because sometimes I face some queries and I'm giving this exam after a long time. I'm not given
Okay.
final exams. So
But I'll just
I
check
don't have.
with the team if we are allowed to share our contact details,
Okay. I'll
right?
just check.
So you do one thing better, you put a mail to BOS seeking the contact details. So if it is allowed, you will be shared the contact details by the BOS itself.
Sure, sir. Thank you.
Fine, better?
Because I was facing some problem and I'm doing it for the very first time, so I don't know means whether I will be able
Understood. No
to.
problem. You can write to BOS. So they will share with you the details, the contact details for contacting us or whoever will be allotted to you for helping you out. So just write a mail to the BOS.
Thank you, sir. Thanks.
Fine, beta. And I will suggest that you take the new module only, download it. Maybe you get it printed if you are comfortable with the physical copy. And now you take your old module, wherever markings you have done, you do the same markings in the new module. It may take a day of your time, but it will be more fruitful than referring to the old module and also trying to track and trace what are the amendments. Because see, these amendments are many and it may have effect in chapters. Now, incorporating the amendments in different chapters itself is a challenge. So instead, I will suggest that you download your new module, take a print, and now open your book page by page and start marking whatever you have done in the old book in this new downloaded module. This will be more effective for your preparations.
Okay. Sure, I'll do this. Thank you, sir.
Please. Fine, Beda?
Yeah, sure, sir. Thank you.
That is all today from my side, students. In the next class, we complete the remaining topics. Thank you. Good day.
Thank you, sir.
Thank you, Beda. Thank you. Students, good day. Yes, Ashokji, we can conclude. Thank you.